we go again after two very intense and strong weeks in terms of macroeconomic data. And remember, what did I say 2 weeks ago? That we are ahead of one of the most important week of the year. Now, that was the inflation data, what we get from the United States and all over the world. And it became hot. But then on the next week, we was waiting for central bank decisions, including the Fed, which also became hot. And the reason why, because there was a black sheep. Now, almost every major central bank decided to leave the rates at the level where they are right now, but the ECB decided on a different path and they raised the rates with another 25 basis points. Now, the result of this is very interesting because something between the two, the inflation data and the Fed decision, happened. And this is the big fish. I was talking to my pro members on the Discord server last week that I have identified the sign of the big fish on the market before the Fed decision. And I emphasize that this is a very dangerous move because regarding what the Fed is going to do, the big fish will react. And the Fed decided to leave the rates, and this was a very big disappointment to the market. And now not only the retail reacting in a negative way, but the big fish as well. As you can see on the S&P/Y chart, this is very, very tense. The volume is very high, well above the average, and for 3 consecutive days. Now, the interesting in the SPY is that we are about to break the bull run and the trend itself. And if we do, that's going to be longer than we expected. Because if the SPY can leave the 200 exponential moving average to the downside, leaving the zone as well underneath and leaving 409.38, this is a green light to the price towards the 388.07 level. Of course, at some point there will be a death cross between the 50 and the 200 moving average, so we need to expect some kind of retest to these levels. But we already see the disappointment of the market. Now, this is not a coincidence because if there is such an economic environment like this, the smart money is always moving itself towards something safer. And I also was talking to my Discord members that one of the safe segment could be the health services. Now, this is a very interesting point, and I'm going to show you a little bit later. But before we do that, let's see the Nasdaq. Now, the Nasdaq doesn't really build to the downside because there is no new lower low level, but there is only the 14,595.55 level. And if we leave this to the downside, we are going to visit the 200 exponential moving average on the daily chart. And so we have a little support between 13,738 and 13,902. This is a no-go zone, but if we leave this too, there is a larger step expected to the downside. So the two big ones, the SPY and the Nasdaq. But what's happening with the Russell? Well, the small cap stocks are also falling, but for a longer term than the Nasdaq and the SPY. And it's not surprising why this chart is looking even worse than the previous two, because obviously small cap companies are losing the gunpowder to make their balance sheet nicer, so everybody knows that they will be the first to fall in the line. Now, this is happening because the DXY is making a crazy run to the upside, but there is something I need to raise your attention to. And this is the 105.789, which is this very resistant. Now, we are in a zone, so obviously we can't do any calculation with the DXY at the moment, but the correction is very overdue because this bull run is one of the biggest one in the last 2 years. So technically we need a correction. And what I expect is that the DXY price will fall back to retest the 50 or the 200 exponential moving average. So retest the golden cross itself. And then we are going to see whether it's going to be successful or not. Now, if the retest is happening, and we can expect the prices falling all the way down to the previous zone between 103.007 and 103.841. If that happens, then we can get a bounce back in the case if the golden cross retest is successful. Because if not, obviously we're going to continue to the downside. But this is a very positive cycle which started 28th of July. The cycle ends on 8th of December. So we still have some time to go to the upside. And this gives the opportunity to attack again the zone between 104.983 and 105.789. Now, at the moment, I think it doesn't really make sense to talk about whether this trial will be successful on the zone or not. But the most important fact is if we don't break this level right now, there will be increased chance to fall back and break this structure and visiting the zone again in the next 2 weeks. If that happens, well, the stock market could breathe up a little bit. And this little bit would be enough, just enough, to bounce back a little bit, making a retest on the broken trend line and then continue to fall. And that's expected on the SPY because we are about to open the cycle. Every single cycle is opening on a positive way, or almost every single cycle. But on a negative cycle, which is expected now, the opening is just about a 1 week correction to the upside, and then we continue to go to the downside, and we expect it to close the cycle on 26th of October on a deeper level. Then we opened it on 20th of September. The Nasdaq is also okay to retest the broken trend lines and then closing the cycle later on 17th of October with a little bit of lower price or very lower price. It depends on how the big fish is reacting furthermore, but I have a guess how. So there is one thing we need to take into account, and this is the possible retest. A little bit of correction to the upside in case the DXY declines just a little bit. Now, there is a very interesting topic, which is the US 30, the Dow Jones Industrial Average Index. As we can see clearly, this is a positive chart, or, well, it a little bit more positive than the Nasdaq and the SPY or the Russell, but there is a reason why. So, as I said, if the big fish is coming to the market and start reacting to the Fed decision, that means they could react in a negative way, because they get disappointed about the Fed that it's not doing enough to control inflation. And obviously, it's not. Or at least from this point, definitely not. And that means that the big fish is start to shifting its money to a less riskier market sector. And that less riskier market sector, in case of the S&P 500, is the health services. As you can see, the last week was very, very bloody for the rest of the market, but the health services. And if we go through the US 30, there is also the health services, the only one which was positive. Okay, not the only one, but in terms of the whole sector. And because there is only 30 stocks in the US 30, it is easier to keep it on the upside a little bit. So that's why the US 30 is reacting a little bit more on a positive way. But don't get me wrong, if the whole market will fall, the US 30 will fall as well. So its day is counted. So we was absolutely right to check the health services, and I hope everybody had enough time to react, or at least on the pro server. And if you're not there, you should be there, because then you will not miss these opportunities. But before you do that, I would like to show you what's going to happen on the next week and what we're going to do with this information. So the Monday will be fairly easy. There will be only the German IFO Business Climate, which will happen on 10 a.m. Central European Time, and all time you're going to see on the screen is in Central European Time. So this is Monday. You can sleep well, you can get your coffee and think through the week. But on Tuesday, we're going to get BOG Core CPI, and this is very, very important because now we are waiting for the BOG decision whether they want to raise the rates, which would be drastic, or not. And obviously, one of the most important macro data could get an answer, or closer to the answer, is the BOG Core CPI. And then we're going to get C&P CS Composite 20 HPI Index from the United States at 3 p.m. against Central European Time. Then CB Consumer Confidence, New Home Sales and Richmond Manufacturing Index, which is really, really important. What we're going to do is check out every single data, check what the possible on each of the market sectors, and then we're going to have a look what is the conclusion of it. So if you're interested about that, pro server. And then Wednesday coming, and for Wednesday we're going to see Australian CPI, but the most important is the M3 money supply from the European Union, because now we're going to see how the money supply is going to change or not. Then private loans, core durable goods orders from the United States, and also durable goods orders, which is very important for the car industry. And then on Thursday, you're not going to be bored because EU German prelim CPI is going to be published, and then from the United States, final GDP, unemployment claims, final GDP price index. Then if you think you're done, don't do that, because on Friday, we are going to have a hell lot of data. So we're going to make a lot of analysis. Now, Tokyo Core CPI is coming on 1:30 a.m. and then China is going to report the manufacturing and the non-manufacturing PMI, which is by the way, way better than in the United States. Then UK final GDP, UK M4 money supply, EU core CPI flash estimate and CPI flash estimate, then Canadian GDP, US core PCE price index, and of course a revised consumer sentiment. This is a very strong week, and I believe if the big fish is already disappointed, might going to be more disappointed on the market. Let's see. We're going to make our analysis and take the right conclusion. If you like this video or like the information I share, just give us a thumbs up, subscribe to the channel so you're not going to miss it. The more people subscribed on the channel takes me closer to start making even deeper content on this channel, so please don't forget to subscribe. Thank you very much for your attention and see you in the next video.